Hi guys, welcome back. I'm back with another video. This video is going to be about mutual funds. A lot of people have personally asked me about mutual funds as they want to invest their monthly savings into it and generate maximum returns possible for their capital. Well, here's your video for today. This video is going to be for beginners and we will understand what mutual funds really are. To start with, mutual funds is nothing but just a service. For example, if you have all the vegetable, spices, proteins, and everything in front of you on a table, would you be able to cook a phenomenal dish if you do not know how to cook? The answer is a big no. So, what do you do? Well, there are only two ways, my friend. Either you learn how to cook or you have to pay a chef. Well, if you choose to pay a chef, it's going to be expensive. So, what do you do? Well, there are a lot of people who do not know how to cook. So, why don't you guys all combine your money and hire a chef to cook something? Well, that's a good strategy, right? That's exactly what we do in mutual funds. We have a lot of stocks in the market. We have Hindustan Unilever, we have HDFC Bank, we have TCS, we have Yes Bank, and we do not know which one to invest into. Well, you don't have to. You can hire a mutual fund manager, and that's what mutual funds are all about. All the people club their money into one mutual fund, hire a mutual fund manager, and that mutual fund manager is a market expert. He invests your money for you to generate maximum returns possible, and in return he charge his fee. We call it the expense ratio. It differs with each mutual fund. Some mutual funds might have higher expense ratio, for some it could be low, but I personally think it just has to make sense. If a mutual fund is generating 5% return, I'm not paying even a penny. If it's generating 15% return, I'm happy to pay 2% in expense ratio. Well, now that you know what mutual fund really is, we would want to deep dive into this topic to know which one would you want to invest into, what's the right strategy, how people invest into it. Well, to begin with, you can just search up mutual funds in India 2026 and you will find more than 250 mutual funds. Well, how do you differentiate between these? First, understand your risk appetite. How much risk can you take? If you are a low risk investor, stick to blue chip mutual funds or large cap mutual funds. These are the big players, big companies like TCS, Bajaj Finserv, HDFC Bank. These mutual funds invest in top 50 to 100 companies of a country. This is very low risk category, but low risk means low return. But if you're somebody who is new into the markets, you can consider this category. That's where I invested my money when I was new to the markets. Second category is mid cap mutual funds. Now, in mid cap, there are a lot of companies like DMart, Hindustan Unilever, uh, I guess ICICI Bank, and a lot of these. These are a little bit more riskier than the large cap blue chip players who've been in the market for long. They are giving consistent returns, but these companies uh, can be a little bit riskier at the same time, and it may do phenomenally well in the long run, and you might make exceptional returns. Asian Paints is one such company which has grown really big and is still a mid cap company. But it grew from a small cap company to a mid cap company, and in next couple of years, it might be a large cap companies. After this category, we have small cap funds. Small cap categories is nothing but the companies which are very smaller in size, and it doesn't meet the threshold of our top indices like Nifty 50, Sensex, and all these. These companies could be Yes Bank, it could be Motilal Oswal, or more such small names which haven't been able to capitalize on their revenue or sales, and they don't meet the threshold to get into our indices. Well, if you're a very risky investor, you might want to invest your money into small cap, but be cautious. More risk does mean more return, but it also means more risk. So you have a chance to lose your capital in this category. So to pick and choose your mutual funds wisely, I've jotted down a few parameters for you guys, which you can look at, go through, and see if it suits you, and then you can pick and choose your mutual fund. The first one is pretty simple: brand name. Don't go with the umble jumbo new players who promise you 36% CAGR in 1 year because they've done it in last 2 years. Chances are they're gonna do bad in coming years because they are already overvalued. My first take is to go with big brand name. It doesn't necessarily have to be a large cap brand name. It could be Axis, it could be uh, some other brand name, but some player who has been in the market for long run. I would pick and choose this brand name first before picking my mutual fund. For example, I see Quant Mutual Fund. Now, this is a new mutual fund, and if you see in 2024, you got a lot of ads, marketing tactics, and all that. People telling you invest in Quant, it's giving 30% return, 40% return in small caps, and now it has done minus 20%. So this is not really what you want to do. If you are new to the market, stick to big players and go to mid cap, flexi cap, or large cap blue chip mutual funds. As you get more seasoned, you might consider small cap category as well. Or if you really want to invest in it, invest small chunk of your capital into small cap category, and as you get comfortable, you can increase it. So this is my first take, and this is what I personally see when I'm picking a mutual fund: brand name. Second one is the expense ratio. Now, I've seen that this is such and such mutual fund. It is good, seems good to me, have done good in the past, giving nice returns, not doing exceptionally well, which is okay to me as long as it has given consistent returns over the years. But I would then look at how much money is the mutual fund manager charging me. Is he charging me 2%, or is he charging me 1%? Or in some cases, he might be just charging me 0.5%. I personally believe expense ratio just has to make sense. If your mutual fund manager is delivering 15% return every year, I would happily pay him 1.5% expense ratio. In contrarian view to a mutual fund manager who is giving 8% return in a year and is charging 0.5% in expense ratio. So if you've picked a good mutual fund which you like and expense ratio is a little bit higher, I would say if it makes sense, go ahead. Our third parameter, CAGR. This just means how much return has your mutual fund given in past years. Well, consider looking at this on 10-year, 5-year, 3-year, and 1-year basis. In 10-year basis, has your mutual fund done 18% CAGR? Well, that's exceptionally well. Is it 15%? That's normal. Is it 12%? It's nice, but could be improved. This is your CAGR. You can look at 10, 5, 3, and 1 year. And if you think it's been consistently doing well, go ahead with this mutual fund. Lastly, your fund category. It's totally your choice. Which category do you want to go to? It will be depicted in mutual fund's name. Let's say, for example, Axis Blue Chip Fund. Blue chip is nothing but large cap. Uh, HDFC Flexi Cap Fund. Flexi Cap It means large cap, mid cap, small cap. It invests in all these category. Another could be HDFC mid cap. This one invests in mid-sized companies, which are usually the part of our Sensex and not Nifty 50. The last one is small cap. Uh, you can search up any mutual fund. I guess there is one from Motilal Oswal small cap fund. We have Franklin small cap fund. This fund category will be depicted in mutual fund's name itself. Depending upon your appetite, you can pick and choose this parameter with however way it suits you. And if you're not sure, you can also go with flexi cap, which gives your mutual fund manager a little bit more room to play with, and he can pick and choose whichever mutual fund whichever stocks does he want to invest into. Could be large cap today, could be mid cap tomorrow, depending upon how much overvalued the stocks are and how does he think the money can grow. And lastly, when you're done picking your mutual funds, you have two ways to invest your money. One is to make one single investment. We call it lump sum investment. This is where you have 1 lakh rupees, 5 lakh rupees, 10 lakh rupees, 15 lakh rupees, and you go all in one go and put your money in. Well, if you're doing that, I have a very important advice for you. Whenever you look at the CAGR returns, see that your mutual fund manager has given good return in 10-year, 5-year, 3-year, but it has given a little less in 1 year or 1.5 year or 6 month basis. So that you know that now your mutual fund is a little bit undervalued, and now it's the best time to invest into this and put your big money into it to get maximum return possible. This is the strategy I personally use. Lastly, you can invest it mutual fund via SIPs. Now, what are SIPs? It stands for Systematic Investment Plan. It's nothing, it's just monthly payments. It could be 500 rupees, it could be 1 lakh rupees, it could be 25,000 rupees, it can be 7,000 rupees, totally dependent on what you want to invest. Systematic investment plan just puts your money into the market every month to reduce your risk. If you're doing SIPs, you do not really want to see if your mutual fund is undervalued or not, because here you're reducing your risk. If it's overvalued, you're going to invest your money again in 6 months. So you might get a discount at that time. If it's undervalued, you're already investing in it and it might not be undervalued. You never know. So with SIPs, you average your entry into the market to reduce your risk, and your returns are usually okay. It reduces your risk, and there is not a big difference. So if you're somebody who's new into the market, I would recommend investing your money into mutual funds via SIPs only. Well, that was it for my side about mutual funds. If you have any doubts or you have more questions, or if you want me to dig deeper into any such topic, you know where to go. Just comment down below and we'll make another video.